Let's get right to it, folks. And there was obviously the beginning of a correction, if you will, and we saw that for sure, Brian. NASDAQ down more than 10%, and so a pretty big hit this week. And, of course, it really made people think, what is happening? I guess you could say it's a number of factors, but certainly on Friday we got a very disappointing jobs report.
We did, yeah. When I saw that number, I had to do a double take. If I wore glasses, I would have probably taken them off and cleaned them to make sure I was reading it correctly, because it was only up 114,000 for the payrolls, but then we also saw the unemployment rate go up from 4.1% to 4.3%. I think one of the more disappointing aspects of that employment situation report, though, for me, was seeing the hours worked, the average work week falling. That's been a trend that we've been pointing out, is that it seems like businesses are hiring, but they're also cutting back on the hours, and the aggregate hours worked actually fell for the month. And I think that the market saw that and started thinking, wow, is the Fed behind the curve again?
Yeah, of course, and that is exactly right. You know, we have obviously been kind of Fed bashers, at least I can say that, you know, obviously they left rates for too long. And I said, let's make sure we don't make another mistake, right? And the fact is that we don't keep rates too high for too long. And that argument is being made. And now, you know, it looks almost certain that we're going to get a Fed rate cut in September. How much is it is really now the debate. Yeah. It was at 25 basis points, but now there's some economists making the play that it should be 50 basis points. So we have an unemployment rate, as you said, is now up to 4.3%. A year ago was 3.4%. So significantly going up by a percentage basis. Number one, rates are high. And by the way, the market rates are really coming down.
They are. There was a huge move in the 2-year Treasury and in the 10-year Treasury when we saw the Fed make their statement, and Powell came out with his press conference and said that he can imagine a number of scenarios where they get anywhere from 0 to 3 cuts this year. The market, those rates came down, anticipating that the Fed would start cutting, let's say by 0.5 percentage points for the rest of this year. All of a sudden on Thursday, we got a bad ISM manufacturing, so Institute of Supply Management, their manufacturing index continued to show manufacturing in a recession. Initial jobless claims rose. The employment situation report was kind of ugly. And now those rates move down even more. So the market is telling us that the Fed is behind the curve, or that if they are on the job, they need to do something bigger.
Let's talk about a couple of points you just made, which are very interesting. Number one, you talked about where the jobs numbers are. We saw that Intel is laying off as much as 15%. We saw that John Deere had some layoffs. So there are companies beginning to lay people off. That's part of the number. The second thing is, I talk a lot about the inverted yield curve. It's beginning to un-invert.
Yes, it is. And that is, just for those who don't know, it's when those short-term yields begin moving down and the long-term yields either stay where they are or start moving up. So we've been in this inversion where short-term yields are higher than the long-term yields for, I think it's been a record as far as how long that has been taking place. It's been a couple of years here almost. And now that's beginning to un-invert. And the question is always about, why is that happening? Is it because the Fed is actually in the act of cutting, or is it because those long-term rates are beginning to move up based upon expectations of faster growth, or maybe because of higher inflation? We've had a lot of volatility with those numbers lately, and our expectation when we were talking on our investment committee is that with this sell-off that we saw in the equity markets, the bond market rallied on that, which is kind of a nice change of pace. If you think about what happened to the bond market over the last 2 years, equity markets sold off, bond market would sell off as well. Well, now diversification is back. It's back in style.
And so let's talk about really the most important point, and that is over the last 4 decades, Brian, we have seen many, many corrections. And the knee-jerk reaction is this going to continue? Are we going to go from down 10% to down 20% and into a bear market? That is the natural concern, and that's why diversification does matter, number one. And number two, do you own quality? And what is in your portfolio? And that's the reason why the investment team has done that. Even as recently as Friday, there was a get-together to talk about what is in the portfolio and is it all quality.
That's right, because what we really want in this environment is not necessarily to just have that emotional response where you see red on the screen and when you're watching CNBC or Bloomberg or Fox Business News and you begin to panic, you're like, oh, I'm going to sell. Well, do you really want to do that? Maybe there are other ways that you can position the portfolio for longer term opportunities. And so what we always do is an X-ray of the portfolio. If you own mutual funds, exchange traded funds, don't just go based on the name. Look at what are the holdings in there. And that's what we do, is we look at that whole cross section, and we want to make sure that it's positioned where we want it to be for long-term success. And so one of the things that we really wanted to do was to make sure that we were in those quality areas where it was coupled with valuation, because I think one of the things that people got caught off guard with is if you buy a quality fund, well, maybe that's really concentrated in mega cap tech. You want to make sure that the name lines up with what's inside of that, and you can't just assume that's the case.
So there's a bunch of things going on, folks. Number one, of course, we have an economy that is under pressure. We have geopolitical chaos around the world. And of course, we have an election coming up. All the reason more that you need to know what you own, why you own it, and how much you're paying for it.